Okay, let's start with a question that it sounds like it was pulled straight from a science fiction novel.
Right.
But it's actually rooted in a very real SEC filing.
Mm-hmm.
What if a corporation, not a government, not a central bank, could essentially engineer its own Treasury Bill?
Yeah.
A sovereign debt instrument, but backed entirely by Bitcoin. Could a company actually achieve the financial sovereignty of a nation-state?
It's a truly mind-bending premise, and until very recently is purely hypothetical.
Really?
But Strategy Inc., the company that we used to know as MicroStrategy,
Right.
is doing more than just answering that question. They're demonstrating it in real time.
Okay.
The core analysis we're looking at today suggests they have, well, fully completed their metamorphosis.
From what to what?
From an enterprise software firm, which honestly feels like a historical footnote at this point,
Yeah, totally.
into the world's first issuer of what we were characterizing as digital credit.
Digital credit.
And the instrument that really defines this whole transformation, the new pillar of their financial architecture, is the Strategic Treasury Reserve Certificate.
STRC.
STRC.
Exactly.
And the STRC is the operational answer to that whole sovereign corporate question. We have to understand it not just as, another piece of preferred equity.
It's more than that.
Analytically, it's a synthetic Bitcoin Treasury Bill.
Okay.
And the strategic genius here lies in its design. It is explicitly engineered to decouple the inherent wild volatility of the underlying asset
Bitcoin.
of Bitcoin and package it into an instrument that offers a stable, predictable, fiat-denominated yield.
It's trying to establish a whole new asset class.
A whole new asset class, Strategic Treasury Reserve Certificates. It's providing sophisticated institutional players with a path to Bitcoin exposure without suffering that day-to-day whiplash.
So we have to ask the critical question then, the one that's at the center of this whole deep dive. Is this just financial alchemy? Turning a highly volatile risk-on asset into something that looks and acts and is marketed like stable, reliable sovereign debt? Or is this actually the future of finance? A future where corporate balance sheets, anchored by hard digital assets, begin to challenge the traditional fiat debt system?
That is the core dilemma. And the source material we're looking at helps us unpack it with just unprecedented clarity.
And what is that source material?
Our analysis today is all driven by Strategy Inc.'s latest 8K filing dated December 22, 2025.
Okay, so very recent.
And this filing, it's not just routine paperwork. It's critical because it confirms the final and maybe the most audacious pivot in the company's entire history.
Which is what?
For the last 5 years, the narrative has been single-minded, aggressive stacking, maximizing the Bitcoin acquisition phase.
Bye.
But this December filing, it marks a sharp, definitive turn.
They've pivoted from that acquisition phase to what the analysis is calling the security phase.
Exactly. They are no longer focused solely on maximizing their stack. Their priority now is ensuring the operational and financial resilience of the massive structure they've built on top of that stack.
And the proof is in the pudding, right? Is in the numbers.
The primary, most compelling evidence is in the numbers. They built a massive multi-billion-dollar USD war chest in a single week.
That cash reserve isn't an accident, is it? Or a side effect?
No, it is the structural guarantee. It is the necessary bridge that transforms the entire enterprise from just being a large corporate Bitcoin holder, which, still carries high perceived risk,
Right.
into a functioning quasi-sovereign financial entity that's capable of issuing perpetually stable credit.
So our mission today is to just dissect that shift completely. We need to go beyond the press release.
Way beyond.
What does this sudden focus on building a defensive liquidity layer, this hibernation defense, what does it mean for the people holding STRCs who rely on a steady yield?
And when we zoom out,
When we zoom out, is this the final step in their financial engineering journey? Is this the thing that truly cements Strategy Inc.'s place as the issuer of a sovereign financial instrument?
one that's capable of attracting the vast pools of capital in global institutional treasuries and maybe even nation states.
We're moving the conversation from, tech innovation to systemic financial architecture.
It's dense, but it's absolutely necessary context if you, the listener, really want to understand how the foundational layers of digital finance are being rebuilt right now.
Welcome to the Deep Dive. I'm Satosha.
And I'm Satoshi.
Okay, before before we jump into those specific and frankly startling numbers from the 8K, I want to take a moment, as always, to welcome you, the listener, to the deep dive. We are seeing just incredible engagement lately for the show that we started with a simple idea.
Yeah.
Is there space for truly deep, research-heavy analysis outside the typical campus lecture halls or, the financial news chatter? And it's clear you're as fascinated by these deep dives as we are.
The feedback has been invaluable, especially on the early conceptual analyses we did around the initial STRC framework. We're so grateful for the community of sharp-eyed listeners and critical thinkers you bring to this discussion.
And to keep producing this kind of content, especially as we look toward expanding into higher quality video analysis to visualize these complex financial architectures.
Which is essential for this stuff.
It is essential for explaining things like the variable rate STRC and the return of capital advantage. We need your help. We're trying to unlock funding for the Mosaic AI video editor by hitting 1,000 subscribers across all platforms.
So please do.
So please, if you enjoy these detailed analytical discussions and you appreciate the shortcut to being well-informed that the deep dive provides, just subscribe. YouTube, Music, Spotify, Apple Podcasts, wherever you listen. Every subscription is a signal that this kind of deep, critical research is valued.
Now let's establish the foundation, because the architectural shift is, I'd argue, the most important element of this whole story.
Okay, so let's start with that philosophical and structural change that the sources highlight. The core conclusion is that Strategy Inc. has completed its metamorphosis from a software firm into the world's first issuer of digital credit. Let's not let that phrase just slide by. How do we, rigorously define digital credit in this context? Why is it such a huge leap beyond just traditional corporate debt?
We define it based on its backing and its perpetual nature. Traditional corporate credit is essentially a claim against, future cash flows from operations or, at best, physical collateral that depreciates.
Right.
Digital credit, in Strategy Inc.'s case, is explicitly backed by a corporate Bitcoin treasury, a massive, perpetually appreciating pool of the hardest digital asset available.
So it's not just a company borrowing money and kind of casually saying, oh, and by the way, we happen to own some Bitcoin.
Not at all. It's about fundamentally restructuring the entire liability side of the balance sheet.
Specifically to monetize that Bitcoin.
Specifically to monetize the Bitcoin collateral in a structurally sound, long-term way, while minimizing the risk of a forced liquidation.
Okay.
The goal isn't quick debt financing. The goal is to leverage that massive accumulated asset base continuously and perpetually.
To fund future growth.
And crucially, to reward long-term investors in a highly tax-advantaged way, which we'll definitely get into later.
And this brings us back to the heart of it all.
The STRC. The Strategic Treasury Reserve Certificate. We characterize it as a synthetic Bitcoin Treasury bill.
Okay, but I have to challenge that T-bill analogy right away. A Treasury bill is the definition of stability. It's sovereign debt. It's seen as risk-free.
Right.
Bitcoin is, by its very nature, violently volatile. How can we possibly reconcile those two things in a meaningful financial sense?
We reconcile them through financial engineering and structural guarantees. That's the entire point of this deep dive.
Okay.
The function of STRC is to strip away the underlying volatility of Bitcoin while delivering a reliable fiat-denominated yield, just like a T-bill delivers a stable fiat return.
So it's like a filter.
Think of historical examples like when bonds were backed by gold. The bond itself was stable and it yielded fiat even if the price of gold fluctuated wildly on the open market.
Okay.
Strategy Inc. achieves the stripping function by implementing two major architectural components: the variable rate structure and that massive cash reserve we talked about. By packaging the volatility away, they create an asset that behaves like a stable debt instrument.
A new asset class.
Their new asset class. Strategic Treasury Reserve Certificates.
That makes the engineering really clear. So let's unpack the yield curve they're building. The sources note they're constructing these diversified liability structures to match different investor profile.
They get that not all institutional capital is the same.
Absolutely.
They have built an entire spectrum of perpetual preferred stock series.
And we have to distinguish the two key products first.
Right. The first one is STRK. That's the 8.00% fixed-rate strike preferred stock.
This one has drawn a lot of attention.
It has, just because of its sheer authorized capacity. They have $20.3 billion available for issuance.
Wow.
That capacity alone signals their ambition. They want to build a treasury operation on the scale of a major nation's debt portfolio.
But the analysis strongly suggests that STRK, the fixed-rate one, isn't the company's long-term vision for this ultimate sovereign digital credit?
No?
Why is the fixed rate considered less sophisticated than the variable rate STRC?
It's attractive, yes, but it's inflexible. In a dynamic macroeconomic environment, with changing inflation, interest rates, central bank policy, a fixed-rate instrument can quickly become rigid.
How so?
Well, if the cost of capital environment changes dramatically, STRK becomes either a huge burden for the company or it becomes deeply unfavorable for the holder. It could end up trading at a steep discount.
Which brings us to the crown jewel.
The STRC.
Formerly, the variable rate series, a perpetual stretch preferred stock. This is where it gets really interesting for the sophisticated investor. Why is this variable dividend rate considered the apex of their financial engineering?
Because it transforms the instrument from a traditional corporate preferred stock into a dynamic, anti-fragile financial tool.
Okay.
Think about how floating rate Treasury bills or sophisticated bank loans are designed. The variable rate allows STRC to function dynamically. It adjusts its yield based on the current cost of capital environment.
So if global interest rates, benchmarked by SOFR or something, were to rise from, say, 4% to 6%.
The STRC dividend adjusts upwards. It maintains its spread and its attractiveness.
That dynamic feature is absolutely critical for long-term institutional appeal, isn't it?
It's everything. Sophisticated treasuries, pension funds, insurance companies, corporate treasuries, they can't afford to be locked into static fixed yields if the Federal Reserve is hiking rates or if inflation is running persistently hot.
They need instruments that automatically adjust.
To maintain their real value and their market relevance.
That means the STRC is engineered to resist one of the biggest risks of long-term holding: duration risk.
It's market immunity built right into the architecture. STRK is the workhorse. It's the high-capacity vehicle for raising capital quickly. But STRC is the highly refined, sophisticated instrument designed specifically for the big money players who demand flexibility, duration, and stability.
An alternative to traditional debt, but backed by something very different.
Backed by a non-sovereign but equally powerful asset.
Okay, let's connect the dots here. The variable rate ensures the STRC keeps its relative value. But that yield promise is meaningless if the company can't pay it.
Right.
And that brings us to the most defining shift in the source material: the dramatic pivot towards security.
The security phase.
This strategic shift in late 2025 marks the definitive transition from the acquisition phase to the conservative security phase.
It does.
Let's talk about that pivot: raising capital without immediately buying Bitcoin. For a company that defined itself by aggressive, immediate deployment of capital into BTC, this is a profound behavioral shift.
It is the moment the corporation decided that structural resilience was more valuable than just marginal asset accumulation.
And the 8K filing from December 22, 2025 gives us the hard data.
Specific, unambiguous data. For years, every single dollar they raised was immediately converted to Bitcoin. That strategic mandate stopped cold during this reporting period.
Let's break down the details from that 8K, specifically for the week of December 15th through December 21st, 2025. What was the capital inflow?
They executed significant common stock sales. They used their at-the-market or ATM facility.
Okay.
The company sold 4.5 million shares of Class A common stock, MSTR, resulting in a net cash inflow of $747.8 million.
Nearly $750 million in 7 days.
A huge vote of confidence from shareholders.
And the critical number, the one that defines this strategic shift in the sources. What about Bitcoin purchasing?
The Bitcoin purchase column for that exact period shows zero. Zero BTC purchase.
Zero.
That is the starkest possible evidence of the strategic pivot. They aggressively leveraged their high-flying equity.
The premium MSTR stock commands.
But they deliberately did not deploy it into the underlying asset.
So where did the $747 million go?
Straight into the USD Reserve.
Okay.
The 8K notes that the reserve had been established on December 1st, 2025 at $1.44 billion.
Right.
And by December 21st, just 3 weeks later, fueled by that massive ATM sale, the liquid cash reserve had swelled dramatically from $1.44 billion to $2.19 billion.
That is a huge jump.
And this increase, it's not passive. This cash reserve, as stated right there in the filing, is explicitly there to support the payment of dividends on the preferred stock, including STRC and interest on their outstanding debt.
Okay, I have to challenge this, though. The sources call it the Hibernation defense, but isn't parking nearly $2.2 billion in USD an asset strategy Inc.? entire philosophy is dedicated to avoiding a massive opportunity cost.
It's an absolutely necessary critical question.
So how does the analysis reconcile holding depreciating fiat for security while its core asset, Bitcoin, is appreciating?
The analysis views it as an insurance premium.
An insurance premium.
The opportunity cost of holding $2.19 billion in fiat is less than the catastrophic risk of losing market confidence because of a missed dividend payment or a forced collateral sale.
So it's about confidence.
The strategic intent is clear. This is emphatically not dry powder for market timing. They are not trying to guess the dip. It is a structural, operational guarantee for the digital credit system they just built.
So how did that reserve translate into a quantifiable guarantee for people holding STRCs?
By establishing a defined risk runway, the analysis suggests it's a 3-year hibernation capability.
3 years.
We can do a rough calculation. Strategy Inc.'s annual fixed and variable obligations, while substantial, are now covered by this $2.19 billion liquid hoard for at least 3 full years.
3 years of guaranteed yield payment no matter what the market is doing. That's the key metric.
Exactly. The core benefit is protection against forced liquidation. The reserve ensures the company is never, under any circumstances, forced to sell its core Bitcoin collateral, its golden goose, just to pay its preferred shareholders their yield.
That effectively inoculates the entire financial structure against short-term market risk.
For a significant duration, yeah. It secures the citadel built on the Bitcoin foundation. The STRC holders know their fiat-denominated yield is safe, even if Bitcoin sees a rapid 50% drawdown.
That structural guarantee is what elevates the STRC from just being preferred stock into genuinely functioning like a Treasury Reserve Certificate.
Where yield assurance is paramount, yes.
They've essentially purchased market immunity for 36 months.
And this cash cushion achieves a critical secondary objective.
Yeah.
It insulates the company from external capital markets.
So.
The filing reminds us that Strategy Inc. relies heavily on that ATM facility to raise cash by selling MSTR common stock.
Right.
If Bitcoin were to crash, the MSTR stock price, which trades at a massive premium to its underlying Bitcoin value, would plummet.
And that plummeting price would mean the equity financing window closes immediately.
Precisely. The cash reserve ensures dividends and operational needs remain safe, even if the highly flexible ATM equity window closes completely for years.
This is the definition of operational self-sufficiency.
In the face of macro risk, yes. This 8K update, showing how they raised money and didn't spend it on Bitcoin, is truly the loudest declaration of their shift from a growth strategy to a resilience strategy.
Let's pivot to another piece of financial wizardry that's essential to the STRC's appeal, but one that often gets overlooked.
The tax advantage.
The return of capital, or ROC edge. For U.S. investors, the source material suggests this makes the STRC potentially superior to many other yielding instruments.
This is a profound and very subtle advantage. It's particularly crucial for high-net-worth investors, sovereign entities, and family offices who prioritize after-tax returns and compounding growth.
Okay, so explain the accounting mechanism for us. Why does HODLing Bitcoin lead to a tax advantage on the yield?
Because Strategy Inc. maintains a perpetual holding strategy, they have very specific accounting realities. They accumulate significant non-cash accounting offsets, like depreciation on their software business assets. And critically, they generally lack traditional distributable earnings and profits, or E&P, because they are not selling their appreciating asset, Bitcoin.
So when they pay the distribution to STRC holders, which feels like a normal dividend, what happens on the accounting side when E&P is low or absent?
A substantial, often overwhelming portion of that distribution is classified not as ordinary income, but as a return of capital.
ROC. Let's make the power of that crystal clear for the listener. Why is this so much better than a typical bond coupon?
The power is tax deferral, which just turbocharges compounding.
Okay.
If you receive a traditional corporate bond coupon or a standard REIT dividend, you pay federal and state taxes on that income immediately, usually at your highest marginal ordinary income rate.
Which could be 37% or more.
Exactly. With a return of capital distribution, you pay zero tax upon receipt. Instead, the distribution just reduces your cost basis in the investment.
Meaning you defer the tax liability for years, maybe decades, until you eventually sell the position.
Exactly. That deferred tax liability, which you didn't have to pay to the government today, remains invested and continues to compound. You only pay taxes, and usually at the lower long-term capital gains rate, when you sell the stock.
So the headline yield of 8% or the variable rate is only half the story.
Right. The real return, the after-tax return for sophisticated U.S. investors, is far higher than a comparable fixed income product.
This is clearly a strategy targeted at sticky, sophisticated long-term capital.
It's part of the corporate sovereign architecture, building an instrument that is resilient, stable, dynamically priced, and highly tax efficient. It's a yield instrument that behaves like a growth investment for tax purposes.
But all of this financial architecture, no matter how elegant it is, ultimately relies on the health of the underlying Bitcoin collateral. We have to stress test the model.
We have to.
Let's look at the foundational metrics from that December 22, 2025 8K filing. What is the current health of the collateral base supporting all this digital credit?
The figures are staggering. Strategy Inc. holds 671,268 BTC.
Wow.
The total aggregate cost basis for that portfolio is $50.33 billion.
Which puts their average cost basis at what?
Approximately $74,972 per BTC.
Okay, so that number, just under 75,000, that sets the crucial financial benchmark for their accounting solvency.
It does. If Bitcoin were to crash below that level, they would technically be sitting on an accounting loss, though that doesn't trigger immediate operational failure.
Right, and we have to be really strict about distinguishing between accounting solvency and operational risk. This is where a lot of analyses miss the mark.
Absolutely. The sources dive into the death zone scenario, while the company is technically solvent on a full liquidation basis.
Meaning the value of the Bitcoin equals all their debt.
Right. That threshold is calculated to be approximately $22,000 per BTC.
That is an enormous buffer.
It's huge.
So if Bitcoin were to crash by 75% overnight, they are still technically solvent based on their long-term debt structure. So total collapse isn't the primary risk being insured against.
Precisely. The real operational risk, which they just spent $747 million insuring against, is the closing of the equity financing window.
Okay.
Strategy Inc. relies on its Class A common stock, MSTR, which trades at a high premium, to raise cash via the ATM. This market mechanism is dependent on investor confidence.
And confidence evaporates at a much higher price point than $22,000.
Absolutely. The sources suggest that if Bitcoin drops below the $75,000 to $80,000 range, which is basically their average cost basis, plus the premium needed to incentivize equity purchases,
Then the market's willingness to buy MSTR stock dries up.
immediately. That's the psychological and market confidence threshold, not the legal one.
The ATM facility is their flexible, low-cost tap for fresh capital. If the market thinks they're underwater, or even near water, that tap closes.
And the moment that tap closes, the company loses its flexible funding source for dividends. It forces them to potentially use operational cash flow or resort to more restrictive, punitive debt structures.
So the strategic choice to raise all that cash and stockpile the reserve to $2.19 billion before any potential dip below that 75,000 threshold
Is the ultimate insurance policy. They have immunized the company against the risk of the equity window closing.
ensuring that the critical STRC dividend remains safe and serviceable for 3 years, even if MSTR equity is temporarily unviable for fundraising.
This single 8K update fundamentally shifts their risk profile. It's no longer just tied to Bitcoin's price volatility. It's now tied to the strength of their own corporate treasury's ability to survive a prolonged 3-year liquidity crunch.
The risk is now defined by the calendar, not the ticker.
A perfect way to put it.
This incredible feat of corporate treasury management, it naturally leads to confrontation with the traditional financial world, doesn't it?
It has to.
The sources introduce this counter-narrative by highlighting the recent and very visible exclusion of Strategy Inc. from the prestigious MSCI World Index.
Right.
And the stated reason was that the company resembles an investment fund, not an operating software company.
That's the technical regulatory mechanism they used for the exclusion. But the analysis suggests this masks a much deeper, more fundamental structural tension.
What do you mean?
We need to view this exclusion not as a bureaucratic mistake, but as a defensive measure. It was executed by the Gatekeepers of Wealth.
Why are they considered such a threat? Index providers are supposed to be impartial.
Because Strategy Inc. is doing something unprecedented. They're creating a legitimate, functional financial product, a Bitcoin-backed yield, that competes directly with traditional regulated asset classes.
Like investment grade, corporate credit, and sovereign debt.
Exactly. Strategy Inc. is challenging the core definitions used by global index providers.
Let's detail why they view it as a fund. A fund's primary purpose is holding assets for appreciation.
Right. And Strategy Inc.'s massive Bitcoin treasury just dwarfs their legacy software business.
The $50 billion in assets makes the software revenue look like a rounding error.
Precisely. The index rules often mandate that companies must derive a high percentage of their revenue from actual operations, not asset holding or financial activities. The index providers are trying to force Strategy Inc.'s hybrid model into a rigid binary docs.
Either you're software or you're a fund.
And they're trying to contain the disruption by preventing the company from being included in massive passive investment pools.
So the exclusion is a systemic defensive maneuver.
Right.
By denying Strategy Inc. access to the hundreds of billions of dollars tracked by MSCI indices, they're trying to maintain the established primacy of traditional fiat-denominated assets.
It is the legacy financial system's predictable reaction to a systemic threat. Strategy's model forces a reevaluation of what constitutes productive capital and what defines a corporate treasury.
And if a company can issue debt that is more resilient, more tax efficient, and yields a higher real return than a traditional sovereign bond,
the established architecture of global finance is fundamentally disrupted.
this brings us to the ultimate extrapolation from the source material.
The endgame.
The profound implication for 2026. Strategy Inc. opening a new window for sovereign wealth funds. If they're fighting the index gatekeepers, their ultimate target must be the nation-states themselves.
The analysis posits STRC as a paradigm shift that specifically addresses the fundamental flaw of fiat-based governance.
Let me explain that.
Consider the dilemma of most governments. When they need to raise capital or service massive existing debt, they typically issue more debt denominated in their own fiat currency, backed by the promise of future taxation.
Which invariably leads to currency dilution and devaluation.
Yeah.
It's a hidden tax on their citizens, trapping them in a vicious cycle.
Exactly. The STRC alternative offers a potentially elegant way out of that cycle for developing nations or, those seeking external reserve.
Excellent.
Strategy Inc. now offers a digital credit instrument that the analysis cites as yielding around 10%, or the variable equivalent in the case of STRC in USD. And it's critically backed by hard digital assets Bitcoin and secured by their $2.19 billion cash reserve.
So instead of a nation-state relying on its own devaluing currency to back its national treasury,
it can allocate a portion of its reserves into the Strategy Corporate Treasury Reserve Certificate.
it acts as a stabilizing anchor, totally separate from their domestic monetary policy.
A nation can allocate its foreign reserves to STRC, earning a high real yield in hard currency, USD, which is then insured against corporate insolvency risk by the sheer size of the Bitcoin collateral and the operational security provided by the 3-year Hibernation defense.
It reduces the immediate pressure on that nation to debase its own domestic fiat currency just to keep its economy afloat.
It's a bridge to stability. The analysis characterizes STRC not just as a product for sophisticated investors, but as a genuine political and economic tool for global treasuries seeking to decouple their long-term reserves from the volatility and dilution inherent in the fiat system.
The language is justified then.
It is. Strategy Inc. has engineered a financial structure. The variable yield, the ROC tax shield, the massive cash hoard that creates a perpetual, highly resilient instrument attractive to capital sources that demand absolute security and scale.
Which includes nation-states and sovereign wealth funds.
And that 8K filing, confirming the zero BTC purchase and the massive cash raise, it confirms the fortress is now in lockdown mode, ready to receive and secure that scale of capital.
They spent years accumulating the asset, and now they are constructing the impenetrable financial fortress around it. They're no longer just riding the wave of Bitcoin appreciation.
They are building the ship that can withstand the storm and issue its own currency equivalent.
So what does this all mean for us? As we look back at the source material, the December 22, 2025 8K filing, and the strategic analysis it underpins, we are witnessing the birth of a new kind of financial institution.
We really are.
It's not a bank, it's not a government, and structurally, it is no longer a simple software company. It is a corporate treasury with the defensive power and sophisticated financial architecture of a sovereign entity.
Strategy Inc. is charting a territory previously considered impossible. They're leveraging the inherent volatility of a digital asset to issue what is designed to be highly stable, fiat-denominated, tax-efficient debt.
And they've effectively solved the short-term liquidity risk of Bitcoin exposure.
Through structural guarantees like the $2.19 billion Hibernation defense and the variable rate mechanism.
This leaves us with a final, provocative thought for you to consider. Is this the definitive future of finance? A new financial paradigm where corporate treasuries issue their own debt, backed by hard digital assets, bypassing the traditional fiat infrastructure? Will we see a world where nations increasingly anchor their reserves to instruments like STRC?
Or, conversely, is this structure, no matter how resilient the engineering, still fundamentally a complex house of cards?
Built on the single, ultimately volatile asset of Bitcoin.
Right. If that critical $22,000 liquidation threshold were ever truly tested, the confidence in the entire edifice could collapse instantly, regardless of the 3 years of cash cushioning.
That's the ultimate systemic risk.
And it is what will ultimately determine whether this is the future of money or the most ambitious corporate cautionary tale in history.
It's a story that is still unfolding, and the analysis we covered today is just a snapshot of a quickly evolving financial landscape. We invite you, our listener, to share your own analysis and sources in the comments.
Please do.
Are we being too optimistic about the resilience of the STRC structure? Are we underestimating the power of the legacy gatekeepers of wealth to successfully exclude them? We want to hear from you.
And we are always looking for collaborators to review our content. If you are a finance expert, a lawyer specializing in preferred equity, or a crypto native with the sharp eye for detail who can spot an accounting nuance we might have missed in the filings, please reach out. We believe in strengthening our analysis through community insight and critical input.
As always, keep searching. Keep the quest for deep knowledge going.